Hello everyone, welcome to Anu's classroom. So as promised in the last session, I am back with the part 2 video of unit 11. Okay, so this is that. So as BOP is a topic of which if you are not from the commerce background, it might be a little difficult to wrap your head around. So before proceeding with the rest of the topics that are there in our unit 11, let us do a very quick recap of what all things we learned in the last session. So what is balance of payments? BOP of a country can be defined as a systematic record of all the transactions between the economic units of one country and the rest of the world in any given period of time. There are two main components of balance of payment, BOP, current account and capital account. We also learned about the basic BOP accounting rule, which states that all transactions leading to net receipt of foreign exchange will create a credit, that is surplus, in the corresponding account, whereas all transactions leading to net payment of foreign countries will create a debit, that is deficit, in the corresponding account. We also saw that a country can have its BOP in equilibrium only when the demand for its foreign exchange reserves equal to the supply of foreign exchange, that is when both the inflow and outflow of foreign exchanges from the country are equal. So now that we have refreshed our learning, let us finally proceed with the rest of the topics that are discussed in this unit number 11 of MMPC 3. So balance of trade and balance of payment. So the balance of trade, BOT, is a major part of the transactions in the current account. So you remember there are two components of BOP, current account and capital account. This BOT, that is balance of trade, is a component of this current account. Okay, it is nothing but the net exports, that is difference between the value of exports and value of imports of a country over a given period of time. The BOT can either be positive, it can be negative, or zero, and it determines if the country has incurred a net profit or a not net loss from the exports. It depends only on the export and imports of goods and services. It doesn't take into account the transfers and financial asset transactions. Okay, so it doesn't consider this BOT, balance of trading, doesn't consider whether some country had bought some stake in our in any company, or or we have sold land to some other foreign company. Nothing like that. BOT, trade only in goods and services. What was sent out, goods and services, versus what was bought in terms of goods and services. That is it. Okay, so a positive BOT may result in a surplus of foreign reserves in the country. Okay, there is a chance, that is it, which can be a major determinant of a sound economy. A negative BOT can definitely lead to an outflow of foreign reserves most of the time, and it can lead to a disequilibrium in the economy's BOP. So the ideal situation turns out when the balance of trade, okay, BOT, equals to zero. That is, your net exports is zero, meaning your imports and exports are of exactly the same value, which may not necessarily be true in all cases, rarely being true in any case, right? So the balance of payments, BOP, is a much broader concept than this BOT. BOT, balance of trade, usually comes as short note questions. Okay, so BOP is a much larger concept than this BOT. Uh, and BOP includes transaction records from trade balance, net transfer, and transfer transactions in financial assets also, like capital account transactions as well. This BOP is an indicator of whether the country is having surplus or deficit of foreign reserves, and any receipt of payment in the form of export payments, gifts, or remittances, or selling of bonds will lead to a surplus in this BOP, whereas any payments such as payment for imports, transfers to abroad, or purchase of foreign bonds will lead to a deficit in the BOP. BOP is a very crucial indicator of whether the country is having a stable economy or not. So what are the factors which affect this BOP? The factors which affect BOP are mainly divided into two groups. The factors which affect the current account and the factors which affect the capital account. So the current account could be affected by rate of inflation in the resident, that is the domestic country, their national income, import restrictions by the government, and exchange rates. While the capital movement across borders could be affected by imposition of tax by the government on the income accumulated by domestic investors who have invested in foreign markets, economic liberalization, or a change in the exchange rates or change in the interest rates in comparison to other countries. So these are the few factors which affect BOP, both the current account as well as capital account. Now, the central bank of all countries will hold reserve of foreign currencies. In India, it is the Reserve Bank of India, right? And this foreign currency reserve is what they can use to finance this deficit in the current account. So, for instance, say a country, okay, say India has a deficit in current account worth rupees 200, okay, and it has a surplus in the capital account worth rupees 180. So, the overall BOP deficit in this case will be 20 rupees. So, the central bank, in our case, in the case of India, it is RBI, it will intervene. Okay, then it can meet, if RBI intervenes, it can meet this deficit by how? By selling equivalent amount of foreign exchange to its importers for payment to foreign country. However, in case of capital account deficit, sale of foreign exchange by RBI may be required for foreign lending or repayment of foreign loans by the Indian residents. Such purchase and sale of foreign exchange reserves by the central bank is termed as official reserve transaction. Okay, an overall surplus in BOP will lead to purchase of foreign exchange assets by central bank, which will expand its stock of foreign reserves. So what will happen? Increase in money supply in economy. Okay, and an overall BOP deficit on the other hand, what will happen? It will lead to sale of foreign exchange reserves by the central bank. So what does that mean? It means depletion of foreign exchange reserve. So what will happen? It will lower the money supply in the economy. In case the Federal Reserve doesn't want to intervene, in case the central bank doesn't want to intervene in this buying and selling of foreign exchange reserve, then the exchange rate, that is the value of home currency relative to foreign currencies, will automatically get adjusted to eliminate the deficits or surpluses in this BOP. So such a system where the central bank of a country will not intervene in the foreign exchange market is called a fully flexible system of exchange, or a clean float of currency. Okay, so now this is a very important question. Okay, this question had come in one of the term and examinations also. Should a current account deficit, okay, always be a situation of alarm? It has, I think, been asked as one of the assignment questions also in previous terms. So let us, I feel that it is important that we discuss this question in detail. To say something about this question, we must first understand what all situations could lead to a current account deficit, right? So BOP has two accounts, current account and capital account, correct? So how all could current account get into a deficit? Only then we can say that if the situations which has led to this current account deficiency be a source of alarm or not, correct? That is a logical way of proceeding. So we just learned now that the factors which affect the current account of BOP are what all? Imposition of tax, economic liberalization, change in exchange rate, change in rate of interest, right? So a current account deficit could signal weaker currency when, because when a country's import is exceeding its export, then also it can cause a decrease in demand for its currency. So what will happen? It will lead to a weaker currency value, right? Depreciation. So what will happen? This will make imports more expensive and leading to higher inflation and reduction in purchasing power. Correct? Also, if a country is unable to finance its current account deficit with its foreign investments, it may need to borrow to cover the gap from outside. What will happen in this case? It will lead to increase in debt levels, which can further harm the economy. But at the same time, a lower current account deficit can boost investor sentiment and make the country's currency more attractive to investors. Correct? So, also a surplus in the current account could indicate that money is flowing into the country, which can boost foreign exchange reserves and the value of local currency. So, in short, what I want to say is that if the current account deficit is caused by an inflow of money into the country, then CAD, that is current account deficit, will be a sign of healthy and robust economy. But if this current account deficit is due to more consumption or unproductive investment or government spending, then current account deficit will indeed turn out to be a severe cause of alarm in the economy. So, as such, we cannot, what you can say, on the face rule out that CAD is good or is it bad. But we can say that we based on how the CAD came about, we can say whether it is a cause of alarm or not. But nonetheless, we can definitely what you can say focus on moderating CAD, current account deficit. How can we moderate current account deficit? By encouraging exports, promoting import substitutions, improving productivity and competitiveness. So all these measures can bring various sources of capital inflows into the country in the form of, say, portfolio investments, external commercial borrowings, foreign direct investments, NRI deposits, all these things, making current account deficit good for the country. Okay, so down off the bat, you cannot say CAD is good or bad. It is whether it is a situation for alarm or not. How we can say is by looking at the root cause of what actually caused this deficit in the first place. Only then we can say whether it is good or bad. Now, anyways, so before we wind up this unit for good, let us take a very quick look at the BoP trends of our country. Now, in your MMPC 3, which was published in around 2021, IGNO has given the trend of period 2020 to 21. Right now, we are at 23 to 24 at the time of recording this video. So, RBI has released the findings for the Q1 of April to June, which is the latest as of recording this video. So I thought that we will be discussing about that rather than the old data which is given in your textbook. Okay, so this is accessible to you guys in case you are wondering where I got this thing from. I've taken this chart from the press release in September, the September press release of RBI site itself. You can go there into the RBI's official website, go to the announcements. You will find this thing in their website. Okay, so according to the Q1 results, India's current account deficit has narrowed to 9.2 billion. Okay, that is 1.1% of GDP in the Q1 of 2023 to 24 from a 17.9 billion, that is 2.1% of GDP when you compare the Q1 of 22 to 23. Okay, but it was higher than the US dollars 1.3 billion in the preceding quarter. Okay, now widening of COD on this quarter on quarter basis was primarily on account of a higher trade deficit coupled with lower surplus in net services and decline in private transfer receipts. Net service receipts decreased sequentially primarily due to a decline in exports on computer, travel and business services, though it remained higher on a year-on-year basis. Non-resident deposits also recorded a net inflow of US dollars 2.2 billion compared with 0.3 billion when you see in quarter 1 of 2022 to 23. Such things. So in case any of you are interested in reading about the past, present or the upcoming BoP trends or any such details, head over to the press release section of RBI website. You can get all the details first hand from the publisher itself. Okay, I have also taken these details from the official RBI website myself as well. So as we wind this session up, I hope that the contents of this course are actually helping you in preparation for your term and examinations, which is just on the in the corner, right? Let me know your thoughts on the contents of Anu's classroom and the kind of videos that you would like to have for successful completion of your MBA course from IGNO as well. I'll try my best to take all your suggestions and make videos in the future. So until I see you all in the next session, thank you so much for tuning into Anu's classroom. Take care. Bye bye. All the very best for your term and examinations.